So, continuing our discussion about the credit rating models, we have considered initially the Z score, zeta score, Zafgrain models and so on and so forth. Then we moved on to a detailed discussion about KMV Corporation's EDF model. So, in the EDF model mainly it was distance to default, even though the underlying concept was probability which you want to find out. So, an extension of the concept used in the KMB model, it would be our discussion as of today and the relevant follow up. In place of distance to default, we may analyze the problem in a slightly different manner, where we want to find out the actual distance to default and the actual probability of non-default. Because why non-default is that rather than trying to analyze from a negative point of view, we will try to basically see what are the positive point of view of using the credit risk model, such that we can also analyze the firms based on the positive statistic. It is like this: we can rank a firm based on the minimum to the maximum on the level of risk. We can also rank a firm considering from the maximum to the minimum considering the positive benefit, or we can rank a firm considering the ratios of what? Ratios can be of return to risk, ratio can be of risk to return, where if it is return to risk, we will rank it from the maximum to minimum. If it is from risk to return, it will be from the minimum to maximum. So, an example of the first type is return to risk would be excess return with respect to sigma, excess return with respect to beta, which we have already done when we were doing the portfolio analysis model. So, here actual distance to default is it would be considered as x1t, which is the actual value of the asset at time t, and x2t is the debt service requirement or DP at time t. So, as we move, obviously this debt service ratio as well as the actual value of the asset may change depending on the time how they are changing. So, what we take in the numerator is the distance or the difference of that, and in the numerator, in order to normalize, we divide both by the expected value and the variance. So, where EMVAT is the expected market value of asset at time t, and VT is the volatility of asset at time t. For the problem just discussed, as we discussed in the last day, if at time t is equal to 2, the actual value of the asset is 250, then the actual distance to default comes out to be 0.037, and we can find out the actual distance to default at different points of time and then rank them accordingly how the company is doing. Now, actual probability to default would be given by the difference. Difference means what is the probability of the actual value of the asset in the absolute sense, and what is the probability of default in the debt service requirement. So, you find out the probability and find out the difference. This is what is exactly is given. In this sense, so this is the probability. So, if I have the distribution like this, let me turn it on its origin space. So, say for example, this is the probability in first case, and if you have the color scheme as possible for the second case, let me see. So, this would be the case if distance to default, another would be the distance to default. So, it will be this case. So, we will try to find out the actual distance to default. So, we find out both the probabilities. So, this one is given by the red one, this one is given by the green one, and based on that we find out the difference. So, this capital phi is the CDF or the cumulative distribution function of standard normal distribution at a value of x. So, it will be x1, x2 depending on wherever you are. For the problem just discuss, if at time t is equal to 2, the actual value of the asset is 250, then the actual probability to default is given by 9%, which is 0.0918. So, this is the actual probability to default. So, this is the difference between the probability on this side, total one, and the probability on this side. So, minus of that is this total area. So, the probability density features values of the asset is given, mean value of the features is given. So, we have that standard deviation which will be given by SD, and then you can find out x1 and x2 are the values. x2 is the value of the asset at any point of time, x1 is the debt service coverage ratio, the debt level. Now, I will consider a few simple consumer finance models. In consumer credit, it means that both short term and intermediate term credit that is extended through the regular business channels to finance the purchase of commodities and services are considered for personal consumption. Example being automobile loans, housing loans, personal loans. It is important to note that the total consumer credit outstanding as it predicts the turn of the credit cycle. So, how fast you are able to get back the money. That means, either the credit card company or the banks which are trying to give a loan on different aspect. So, we will consider the CCR or the credit change ratio is basically how the credit risk value is changing on the ratio concept is basically given by the ratios of consumer installment credit outstanding and the personal disposable income. So, you have a personal disposable income, based on that you spend your money on different account. So, you want to find out that what is the change of the credit change ratio, change of that depending on two different time periods. So, if you find out the ratios at t and t minus 1 or t and t plus 1, you can find out the differences which will give you the CCR. Another ratio of interest is the debt service payment ratio. Its value is given by the ratio where in the numerator you have the payment of mortgages, payment of credit card, payment of personal loan, payment of auto loans, payment of other loans, and the total value is the disposable income. That means in the denominator. What you are doing here in the numerator, you are trying to basically break down all the loans in different concepts based on the fact whether they are personal loans based on credit card, personal loans based on automobiles or other loans or educations, whatever they are trying to basically build up blocks as that you are able to concentrate on each and every level and find out the DSPR, which is the debt service payment ratio. For consumer finance model, for loan application evaluation, the companies use both judgmental credits approval criteria as well as quantitative credit screening models. Under the judgmental one, you have the age of the applicants is important to know that, current address of the residential address of the applicant is important, current phone number, in what type of job the person is working, whether the person has taken any loans, what is the salary, what type of business the person is, all these are taken into account. Similarly, we can have many such criteria on which we can base our actual analysis. So, quantitative credit screen model falls under two broad categories. One is credit approval models and one is behavioral scoring one. The former is used in a research and a decision making model, whether to extend the credit, yes or no. And in the credit approval model, there are different type of criteria or parameters. One is age, one is house, whether rented or owned, one is the years present at the residential address, number of dependents, what is the income per dependent, what is the disposable income, what is the marital status, whether the occupation is government, private, business or doctor or whoever it is, years in the present jobs, the telephone number and all these things are noted down, so that it gives you much better and holistic information about the credit approval models you are going to based on these facts. Depending on criteria mentioned above, we can assign a score for each of them. Like if the house is rented, we can assign a sign of 0. If it is owned house, it is basically +1. If it is a business, we give a score of, say for example, +1. If it is that of a government one, we give a score of +2. If the person has a car or is rented one on our mortgage one, then we give different scores. If the person's age is very high, it's an older generation, then we give less score. If a younger generation is a more score, which means that it gives you some information about the credit worthiness of the person and also reflects what is the overall so-called credit risk the company would face in case there is a default. On the other hand, behavioral scoring models are used to improve the profitability of accounts by subjecting them to different treatment with regard to credit terms. It is based on the fact or the information needed are number of credit requests, credit inquiries conducted, total number of credit approval given, total transaction approved, so on and so forth as stated in this slide. Now, one thing is very important to understand is that for any credit rating models, there are some sort of risk. Risk is not the point which we have already discussed, we have been discussing, there is some sort of uncertainty. So, what is that uncertainty we will discuss. So, consider from the very simple statistical point of view, there are two type of hypotheses. One is the null hypothesis, one is the alternative hypothesis. Null hypothesis is H naught, alternative is HA. So, these are the one which you are considering, H naught and HA. So, this is the null, this is the alternative. Now, in this case we can have two type of errors. Why two type of errors and how what the implications are, I will come to that later, but first let us note this matrix. So, consider that we are taking a decision and there is one state of the nature which we are not aware, that consider that state of the nature as a omnipotent God or whatever supreme power who has all the information, and we are taking a decision and we are trying to benchmark our decision based on the omnipotent decision, which may be true, may be right, means whatever we are taking may be right or wrong. So, consider that there is an alternative one which is H A and there is a null hypothesis which is H naught. Now, consider that we due to some reason the first row we consider you reject H naught. So, if you reject H naught and actually H naught is true by mother nature, then there is obviously an error on our part. So, consider that as type 1 error and the error is given by alpha, that means there we are erring and we are basically making a mistake. On the other hand, if we reject H naught and mother nature is also saying that H A is untrue, that means H naught is actually true underlying fact, then obviously there is no error as such and we are in line with whatever we are saying. In the second case, consider that you accept H naught and H naught is true, which means the overall error which you are going to make is basically 1 minus alpha. Error means we are going to consider both on the positive and negative side. I may be using the word error, but error would be positive or negative depending on whenever we are taking a decision which is in line with nature and which is in line with not in nature, mother nature. So, what is important to note is that if we reject H naught, but still H naught is true, this is the error we make in the first instant. And in another case, if we accept H naught, that means we are rejecting H A and H A is true, this is the error. So, what our main concern are these, which is alpha and beta. These are just the counterpart of that 1 minus beta and 1 minus alpha. So, type 1 error basically means out of this alpha and beta, this type of error is committed when we reject the null hypothesis H naught when it is true, it is denoted by alpha, and type 2 error is the type of error is committed when we accept the null hypothesis H naught when it is false, it is denoted by beta. So, in the case when it is type 2, we accept the null hypothesis 1 and we try to find out what is the error in that. So, if you want to see from the pictorial point of view, let us draw the diagram as follows. So, consider I am using the scales of the x and the y axis as per financial concept, even though it can be done in any concept. It can, and rather than doing from the statistical point of view, I am trying to basically give the information based on the very simple credit rating or credit finance model. So, consider now you are a banker. And as a banker, you have been given the task to analyze whether a loan should be given or not. So, in a bank, you have the set of papers, there is a form, and in the form there are different type of scores which you have assigned, whether the person, what is his or her age, what is the type of business the person does, whether the person has his or her own house, whether the person has a higher education, whether the number of dependents is high or low, whether the person has a government job, so on and so forth. So, based on that you have different set of criteria and consider the overall score based on which you will try to analyze the person who has given a request for a loan is 100, consider it hypothetically. And also consider hypothetically that you have agreed that if the score is 60 and more, you will give that loan. If the score is 59 and less, obviously you would not give the loan. So, that means there is a cutoff value, and let us consider the straight and dotted lines which you have is the 60 score here in this diagram. Now, what are the two graphs? Graphs means these are normal distribution, even though they have not been drawn as normal, but I have tried my level best to draw it as a normal distribution, but they are normal distribution. So, if you consider the first graph, it means this is the distribution of the people to whom you are willing to give the loan. So, obviously, their average score you will consider is greater than 60, consider it is 70, hypothetically consider it 70. So, the distribution is basically gives you the type of account who are good in nature, in the sense that if you give the loan, there is they would return the loan. But as you are trying to analyze the problem from the probabilistic point of view, if you check the area which is on the left, which is the blue one, blue hashed area, it means those are the people who have the propensity to return the loan, but you have analyzed them to be on the lower scale where the overall score is less than 60, which means that you would not give them the loan, even though if you had given the loan, they would not have defaulted. Now, consider That means this type of this green one, where I am basically putting all the green color, which was actually blue earlier, are the set of people who are your potential customers who would not have defaulted, but you are losing a business. So, this is a type of error you are doing where your loss of business is there. Now, consider the other graph, again it is a normal, but their average score for people who will default is 50. So, obviously, you would not like to give them a loan, but see very carefully, let me use the color as red. So, these are the people where you would not give the loan actually, but unknowingly depending on different criteria based on which the forms have been filled, you give the loan. So, if you give the loan, there is a probability that they would definitely default. So, this is the level of beta, which is the default risk, which is the type 2 error which you have committed for those people who should not have been given the loan, but you have given the loan. So, if you see combined effect of alpha, which is there on the right hand side, and beta, which is on the left hand side, these are two type of errors which you have committed for one set of people. You should not have given the loan, you have given the loan. One set of people, you should have given the loan and you have not given the loan. So, if you combine both of them, this is the overall risk you are facing. Now, consider another important concept. Consider that you are trying to change this score, middle score of 60. Consider you make it 65. So, 65 means it will shift to the right, or you want to make it 55, it will shift to the left. But if you see that, you will very clearly understand that trying to minimize both alpha and beta, which should be done, is simultaneously not possible. That means, you cannot decrease alpha, you cannot decrease beta at the same time, because if you shift it more to the right to 55, or you shift it more to the left, which is 50, shift it more to the left, which is 55, and and if you shift more to the right, which is 65, you will see the values of alpha and beta changes differently. How? Make it 65. So, consider that you are making it a value of 65, which is here. So, in this case, the overall risk coming from the red area has now decreased. So, it is decreased. But if you consider the overall area from the point of view of the blue one, it has increased. It means this is the extra part which you are trying to take. Now, consider the picture from the other point of view. That means, beta is decreased, alpha is increased. Now, consider the picture where your actual score is now 55. In this case, beta has now increased, and while alpha has decreased. So, that means, for this situation which we are trying to analyze, changing score to 65 or changing to 655 would have two effects. In the first instance, beta decreases, alpha increases, in this case beta increase, alpha decrease, which means individually you cannot decrease them. So, what is to be done? Best answer is decrease the value of sum of the errors, which is alpha and beta. So, you want to bring it into such a level that the overall risk which is emanating from the case of type 1 and type 2 errors would be decreased to the maximum possible extent, as that the sum is decreased and made to the minimum level. So, remember the following: you will reject H naught, considering the H naught to be true is alpha, you will accept H naught, that is you will reject HA, considering HA to be true is beta. Power of the test will be given by 1 minus alpha, which is basically rejecting H naught given HA is true. So, but our main concern always remember is alpha and beta, which is type 1 and type 2 errors. So, remember a metric or scaling system is developed for each attribute for credit application. For example, it is often more convenient to deal with income in categories under 10,000 rupees, between 10,000 to 15,000, 15,000 to 20,000 per month, so on and so forth. It is important to note that different type of statistical analysis, logit, probit model, logit model, principal component analysis, survival analysis, etc. can be utilized to basically mark and find out good finance consumer finance model. After the model is found, it is tested for statistical validity. One commonly used best test would be to compare the scores distribution for the good and the bad sample. If the test of significance shows that the score distribution are statistically significant, then definitely you utilize that model for future studies. If it is not, then obviously we will try to analyze, recalculate your model, make your model differently and do the calculations again. So, with this I will end today's lecture, and then tomorrow we will start off the extension of this ALM model and other things, which would be an extension of the consumer models, but in a different way where we will consider the portfolio models extension also. Thank you.